Gold and silver didn't just bounce today. They forced the system to pay attention. In just 30 hours, gold and silver together added $3.07 trillion in value. Silver is now almost 20% up from its bottom, back above 88, and silver alone has added roughly $800 billion. Let that register. Nearly $4 trillion recovered in only 30 hours. This wasn't a slow recovery. This wasn't a routine relief rally. Out of the recent $11 trillion market wipeout, roughly 35% was recovered in just 30 hours. And this is where the message changes. Money doesn't move that fast unless the market isn't reacting anymore. It's repricing. Gold surged about $311 in a single day. That's the largest one-day dollar gain since 2008. No CEO, no earnings call, no boardroom decision. Just one trading session, and roughly $2 trillion shifted. About the entire market cap of Amazon, without any announcement. That isn't noise. That's a warning. Gold is up about 6%, roughly $286 per ounce. Silver is up about 14%. When gold, silver, and copper all surge together, it's not speculation. It's the system adjusting how money is valued. Jesse Livermore used to say the market speaks first and explains later. Smart money listens first. Questions come after. And what most people aren't connecting yet is this. The physical silver market is under extreme stress. Physical silver is becoming nearly impossible to source. Dealers are reporting serious strain in the physical market, with silver being the tightest. Mints are shut down. Refineries are backed up. Most competitors are out of inventory. A few dealers still have supply only because they planned well ahead of time. Even they are now adjusting premiums and minimums to reflect real physical conditions. This is not paper volatility. This is a real-world supply issue. Yesterday, a move into the high 80s was discussed. At the time, price was trading near 80, and that zone wasn't random. It represented a key technical confluence. Price didn't reach it immediately. Today, it did, and it was rejected. That rejection will matter later when we get to the verdict and the signals at the end of this video. Right now, silver pricing is clearly split across regions. Western spot and futures are trading around 85. Shanghai spot is near 100. Shanghai futures are around 101. That creates a $15 premium, roughly an 18% gap. Healthy markets don't show gaps like that. That happens when physical demand overwhelms paper pricing. A few days ago, attention was drawn to a key technical level, the 150 exponential moving average on the hourly chart. The idea was simple. If price closed below that level while trading above 100, lower support zones could come into play. Price initially bounced exactly as expected. Then another scenario was outlined. If macro pressure increased, particularly from central bank narratives, price could move even lower, potentially into the mid-80s. That was not a signal. It was a scenario for planning. There is a difference, and confusing the two is how traders get wiped out. Now we're here. After an 18 to 20% bounce from the lows, some are already calling a bottom. Markets rarely reward that kind of certainty. What the data actually shows is this. Open interest has collapsed. With contracts rolling off and liquidations accelerating, COMEX gold open interest has fallen to its lowest level since June 2025. COMEX silver open interest is at its lowest level since May 2025. Those are classic capitulation readings. When open interest falls this sharply, weak hands are flushed and leveraged positions are forced out. That's how lows form, though not always immediately. At the same time, an important shift has occurred. The 150-hour EMA, which previously acted as support, is now sitting near 96 and acting as resistance. When support flips into resistance, the burden of proof shifts. Silver pushed into the 87 to 90 zone and failed. Buyers tried to hold it. They couldn't. Price fell back to 85. That rejection matters. And this is where the real battle begins, because the technical picture and the fundamental picture are now pulling in opposite directions, and that's what creates violent markets. On the bearish side, the structure is clear. The 150-hour EMA, now sitting near 96, has flipped from support into resistance. That's not a minor detail. Markets remember levels. When price loses support and fails to reclaim it, sellers tend to defend that zone aggressively. Silver already tested the 87 to 90 area once and failed. Buyers pushed, momentum slowed, and price rolled back down to 85. That rejection tells you supply showed up where it mattered. Until that zone is reclaimed and held, upside remains technically fragile. Macro pressure adds to that risk. Bitcoin has dropped below 74,000 for the first time since April 2025. Equity markets are under pressure, with the S&P 500 closing lower and the Nasdaq seeing heavier losses. Sentiment indicators have slipped back into fear territory. At the same time, global bond yields are rising together, which is rarely bullish for risk assets in the short term. Germany's 30-year bond yield has pushed to its highest level since 2011. The U.S. 10-year Treasury yield is approaching levels last seen in August 2025. Japanese yields are nearing highs not seen since 1999. When yields spike globally, liquidity tightens. In those conditions, markets often sell first and ask questions later. Metals are not immune to that initial liquidation phase. Geopolitical risk adds another layer of uncertainty. Reports of escalating tensions involving the U.S. and Iran are circulating. Whether confirmed or not, markets tend to react immediately to headlines. The first response is usually risk off. Raise cash, reduce exposure, wait for clarity. Safe haven flows often come later, not at the first headline. That's the bearish case. Resistance overhead. Risk off sentiment spreading. Liquidity tightening. The possibility that price could still retest lower levels if buyers fail to reclaim key zones. But stopping there misses half the story, because the bullish case is just as loud, and it's coming from places that don't lie easily. Physical silver remains extremely tight. This isn't a rumor. Mints are still closed, refineries are still backlogged, many dealers are effectively out of stock. Some have reduced minimum purchase requirements simply to keep metal moving, adjusting from 20,000 to 10,000 Singapore dollars to reflect real supply conditions. That doesn't happen in a healthy market. Paper prices can move up and down quickly, but physical shortages take time to resolve. You can't instantly reopen refineries or restock mints. When physical stress reaches this level, it creates a floor beneath the market, even if price chops around above it. At the same time, futures market positioning shows exhaustion. With COMEX gold open interest at its lowest level since June 2025 and silver open interest at its lowest since May 2025, much of the forced selling has already occurred. Leveraged longs have been flushed. Weak hands are largely gone. That doesn't guarantee an immediate rally, but it does mean the fuel for panic selling is diminishing. And that's why this moment matters. The paper market is saying caution. The physical market is saying scarcity. Those two forces are now colliding. In the next part, we'll go deeper into the bullish signals, central bank accumulation, long-term demand trends, historical volatility in precious metals bull markets, and why some analysts are raising long-term targets during panic. Then, in the final part, we'll pull everything together and lay out the verdict and the exact signals that decide whether this rejection leads to another drop or marks the final shakeout before the next leg higher. To understand why this moment is so important, you have to zoom out beyond the hourly chart and look at who is actually buying and who isn't selling. Central bank gold demand remains exceptionally strong. In 2025, central banks purchased 328 tons of gold, just slightly below the 345 tons bought in 2024. Poland led the purchases with 102 tons, followed by Kazakhstan with 57 tons. This marked 33 consecutive months of net central bank buying. That's not speculation, that's policy. The 12-month moving average of central bank purchases now sits near 27 tons per month, a level that confirms this is not a short-term trend. It's a structural shift. Central banks are not trading gold. They are accumulating it regardless of short-term price swings. This matters because it puts a long-term bid under the market that paper traders cannot see on intraday charts. At the same time, respected analysts are raising long-term targets, not lowering them. David Hunter recently raised his gold price target from $5,500 to $6,800, and his silver target from $125 to $180. These revisions didn't happen during euphoria. They happened during volatility and fear. That's usually when the most important long-term calls are made. History supports this behavior. During Germany's hyperinflation from 1914 to 1923, gold prices rose roughly 1 billion times in local currency terms. But the path was anything but smooth. Monthly price swings ranged from minus 30% to 160%. Even with perfect foresight, holding through that volatility would have been psychologically brutal. Violence in price is not a sign of failure in precious metals bull markets. It's a feature. What we're seeing now fits that pattern. Sharp sell-offs driven by leverage, explosive rebounds driven by fear, then consolidation as the market searches for balance. Fundamentally, nothing has changed. Global debt levels remain elevated. Currency debasement continues. Industrial demand for silver is still growing. Central banks are still buying. Physical supply constraints have not been resolved. The mainstream narrative suggests recent price declines were justified because of expectations around central bank leadership and policy independence. That explanation doesn't hold up under scrutiny. Gold does not need approval from central bankers, politicians, or headlines. There are billions of people globally, particularly in China and India, whose focus is on saving in real assets, not expanding fiat exposure. Their demand does not disappear because of short-term policy speculation. In terms of key levels, gold found support near 4,400, while silver stabilized around 70. These zones carry historical significance and acted as support during the recent liquidation phase. Whether they hold long-term will depend on future price action, not opinion. Another important macro signal is currency movement. The Chinese yuan recently strengthened to its highest level against the US dollar since May 2023. A strengthening yuan alongside a weakening dollar historically supports higher precious metals prices in dollar terms. Pricing power is gradually shifting east. This brings us back to the present setup. Paper prices are volatile. Physical supply is constrained. Central banks are accumulating. Futures market leverage has been flushed. These conditions rarely persist without resolution. In the final part, we'll bring everything together: the technical rejection, the physical shortages, the macro risks, and the positioning data, and lay out the verdict along with the exact signals that determine what comes next. So where does this leave us? It leaves us at a point where certainty is dangerous, but preparation is essential. Let's recap the facts that matter, because opinions don't move markets, data does. Gold just posted its largest one-day dollar gain since 2008, moving roughly $311 in a single session. Silver surged 14%, rebounding nearly 20% from its lows. In just 30 hours, gold and silver together added roughly $3.07 trillion, with nearly $4 trillion recovered overall, about 35% of the recent $11 trillion wipeout. At the same time, the physical silver market is under extreme stress. Mints remain closed, refineries are still backlogged, inventory is scarce. Dealers are adjusting minimums and premiums simply to maintain access. This is not a paper issue. This is a supply issue. Futures market positioning confirms that much of the forced selling is already done. COMEX gold open interest is at its lowest level since June 2025. COMEX silver open interest is at its lowest since May 2025. That kind of collapse typically marks capitulation. Weak hands have been flushed. Leverage has been reduced. Central banks continue to accumulate gold relentlessly. 33 consecutive months of net buying, 328 tons in 2025, following 345 tons in 2024. This demand has not slowed despite volatility. It is structural, not speculative. Now let's address the technical reality. Silver pushed into the 87 to 90 zone and failed. That rejection matters. Buyers could not hold that area. Price fell back to 85. The 150-hour EMA, now near 96, has flipped from support into resistance. Until price reclaims that level and holds it, upside remains unconfirmed. This is where many people make mistakes. They hear bullish fundamentals and ignore technical risk, or they see technical weakness and ignore physical reality. You cannot afford to ignore either. So here is the verdict. This market is not confirmed bullish yet, but it is also not structurally bearish. The violent sell-off has already done much of its damage through liquidation and capitulation. The physical market is signaling scarcity. Central banks are signaling accumulation. Those are not conditions that support a long-term collapse. At the same time, the rejection at 87 to 90 and resistance at 96 tell us that the market has not proven strength yet. That proof must come from price. These are the signals that matter going forward. If silver reclaims 90 and holds, and then begins to challenge and close above the 150-hour EMA near 96, that would be bullish confirmation. That would suggest the low is likely in and the next leg higher is underway. If silver fails to reclaim 90 and instead begins to test 80 or lower, then another downside probe becomes likely, potentially even a retest of the 70 area before a more durable bottom forms. There is no guessing required. The signals will come from price. Gold, silver, and copper moving together tells us the system is still repricing money. Bond yields, geopolitical risk, and global liquidity conditions will continue to inject volatility. Headlines can reverse price action in hours. This is not an environment for leverage. This is not an environment for certainty. For long-term holders, daily volatility is noise. If your thesis is currency debasement, central bank accumulation, and physical supply constraints over years, nothing in the last few days has broken that thesis. For traders, every level matters. Know what you are watching. Know your risk. Know what invalidates your idea. The market doesn't care what anyone believes. It only responds to positioning, liquidity, and supply. Right now, the paper market is hesitant. The physical market is stressed. Which one wins will be decided by the signals ahead, not opinions. and that decision is coming soon.